Hello and welcome to this video. This video is really straightforward. We're an accounting firm and we're going to give you 10 tips to make sure your business goes from conception to glorious. Stay tuned. Hello, my name is Patrick. I'm a chartered accountant, a certified UK trainer with fancy new logo, that QuickBooks Chap on the internet, head of accounts here at Boffix, and also your friendly podcaster who goes live 8:30 every single Monday morning for Ask the Accountant. Now today's video is straightforward. We're going to be jumping in and talking about exactly how the 10 tips that I can think of to make sure that your business is a success. And how we're going to do that? We're going to make sure that you understand the fundamentals of accounting. Let's go. Accounting is a crucial skill for anyone who wants to manage their own finances. However, accounting can also be intimidating and confusing, with loads of confusing terminology, and there's going to be a lot of opportunity for you to understand exactly what to get out of this. For any small business, accounting is a crucial skill, and what it means is it's going to help you understand exactly all the concepts and terminology and help you better understand what you are going to get out of creating a set of accounts, or at least being provided a set of accounts by your accountant. Some of the main benefits of accounting, such as helping you make better decisions, help you understand the tax laws, help you monitor your performance. This video is going to give you everything you need. We're going to cover the foundations, the simplicity, and we're going to make sure that you understand exactly what it is. First of all, what is accounting? Well, basically, it's really straightforward. It's about making sure that you're summarising, recording, analysing all of your financial data. If you think about it, at the end of a year, you're not given a pay slip or anything like you are in a standard job. Accounting is about making sure you understand exactly how your business is done. And the only way to do that is to monitor it and to record it properly. It's all about monitoring your performance. It's all about making sure that your business understands how it's done in a particular period. Now that period could be a year, it could be a month, it could be a week, but ultimately it's the whole point of accounting is so that we can record what's happened in your business and give you an opportunity to see what that compares to, maybe against a different period. Or you're going to compare it against a different entity, someone that might be doing really well in your sector, or someone that's showing you the way forward. Either way, unless you've already analysed your own business, it's going to be very difficult for you to understand how your business is doing. So the first thing to understand about accounting is what's it for in the first place? Well, it's about making sure that you understand the importance of recording all of your financial data so you can make the better decisions. The fundamental of accounting is all about the balance sheet, and it's all about this thing called an accounting equation. It's the whole foundation of what accounting is, and in simplistic terms, basically it means that every time there's a debit, there's going to be a credit. Now that seems really confusing, right? But ultimately it all comes down to what's called the accounting equation, which is assets equals liabilities plus equity. And again, all of these words may not mean too much to you, but if you think about it like this, asset is everything you own. And it should mean that everything you own is equal to everything that you owe, which is the liabilities, plus what you've already invested in, which is your equity. And the balance sheet is so important because the balance sheet is effectively going to show you that in a line of sight, if you put a line of sight in your business, then that's what your business is worth at that point. It will show you all of the transactions that relate to all of your assets, all of those liabilities, and all of those equities. So the balance sheet is by far the most important part of your financial statement, of your account. And if you draw a line in it, that should tell you effectively on paper what your business is worth. It should show you all of your assets, like the money in your bank, and all of your fixed assets, and all the debtors that owe to you, and all your liabilities. So if you owe money to, say, a loan or to creditors, that should be shown there. And finally, it's going to show you the equity, how much money has been invested, how much money is owed to your investors as well. If you fundamentally understand a balance sheet, and the best thing to do is just Google balance sheet and have a look at a couple of them, or just go online and go to Companies House and start looking at maybe rivals, for example. As you start to understand what those balance sheets are, you're going to be most of the way there to understanding how the financial statements can help you in your business. Now, when you first start out in business, one of the big things you're going to understand and figure out is the difference between cash and accrual accounting. Cash accounting is really straightforward, and actually it's the simplistic one out of all of them. Cash accounting is basically when you go, let's take your bank statement, every time money goes in and money comes out, then we're going to record those transactions. Straightforward, right? Now, majority of the time when you start a business, you're going to be given a period of time when you can record from a cash accounting point of view. The really small businesses out there are allowed to do that. They're given that affordability. They're given that opportunity because it's so much more simplistic. But really, every single business should be looking to go on to what's called accrual accounting. And the big difference between a cash and accrual basis is cash is just when the money comes in and out of the bank account. Accrual is when you're starting to think about, well, actually what is due to come in and out of the bank account. For example, if you're one of those businesses who produces an invoice and gets paid 30 days later, or hopefully gets paid, then you want to be recording the invoice when you send the invoice, not when the money receives in the bank. Same with expenses. If you are actually due to pay something, you should be putting the date that you're due to have that invoice, not the day that you actually make the payment. The benefit of accrual accounting though is really straightforward, because basically what you're going to see is a true representation of how your business is doing. And it's not, and it can't be masked. There's no hiding away. Accrual accounting really does show the true meaning of how your business is doing. So it's really important that you kind of move your way and get yourself there as well. One of the disadvantages though is it starts to make cash flow really difficult to understand, because you're recording money that's not quite in relation to what's going through your bank. So there are advantages and disadvantages of each method, but you need to be making sure you're doing it right for your business. Income statement and statement of cash flows, these are going to be great and very important statements within your financial statements. The whole idea of an income statement is straightforward, right? It's the profit, so how much money your company's made, which is made up of income that the company's made less any expenses. Now when you come to expenses, you should be split into at least two different types of categories. Cost of sales, which is how much is directly related to your income, and administration expenses. Administration expenses is the easy one to get your head around. They're going to be costs that you're going to incur regardless if you make a sale or not. Think of rent, heat and light, things like that. Cost of sales though, that's a little bit more tricky to get your head around. And cost of sales should represent directly to the sales that you've made. So the idea would be the more sales you make, the more cost of sales you incur, i.e. if you're buying and selling actual items, you've had to buy more items in to be able to accumulate and actually make those sales. Or if you are providing a service, you've had to bring in more labour and cost of labour to be able to produce those sales. Cost of sales should be directly in proportion to what your income is. And statement of cash flows, dead straightforward. All we're doing is we're taking that accrual basis and we're bringing it back down to what that really means in cash to make it understandable for people who are reading the actual statement. Because if you think about it, if we're moving over to accrual accounting, we may not be able to completely see how cash rich our business is, or if our business is going to become into cash difficulties sooner rather than later. And when we prepare a set of accounts, we should always be concerned about what's called going concern, which is basically thinking about how likely that business is going to continue in the future. Well, that's going to be really important to us, right? And we need to have a cash flow forecasting solution, a statement of cash flows, to understand exactly how our business is going to do from a cash point of view. Okay, the next concept is double entry bookkeeping. Now that's been around for donkey's years, and double entry is basically this fundamental point of how bookkeeping works. In the simplest terms, basically when we look at double entry bookkeeping, what we're talking about is the fact that every time we put an entry into our books, we are affecting at least two different areas, and those two different areas must both equal the same as one another. So in simplistic terms, if you go all the way back to your bank, if you're going to put money into your bank account, then that's going to increase your bank. So the way we call that is a debit. Now, if we've put a debit into it, due to double entry bookkeeping, that means we also have to put a credit. And if we've increased our bank as a debit, then the credit is going to be sales. My easiest way to understand, and the way I would recommend to everyone, double entry bookkeeping should be remembered by thinking about how it affects your bank. Because we all understand that when we increase the bank, when we put a debit in there, it goes up. That means it needs to have a credit that equals it to be able to put against it. If we spend money, then it's going to credit, it's going to reduce that bank account. So then we need to put a debit in to represent what the expense is going to be. Debits and credits will blow your mind at very first, but I promise you, it's one of those things that once you get your head around it, understand it, then it's going to become second nature to you. Now, once you've got your head around debit and credits, the benefit of that is then you can use journal entries to really get to grips and understand how your business is doing. Now, most accounting solutions out there make it really easy for actually putting bookkeeping transactions in. Most of them now will connect bank accounts up and they'll do a lot of the automation for you. And you don't really need to worry about debits and credits at that point. But to truly get the most out of your bookkeeping, to truly understand exactly how your business is doing, and to take your bookkeeping to that next level, you need to start understanding journal entries. And basically, journal entries take that double entry bookkeeping transaction that we just talked about and the concept of double entry and puts it into a solution where you can actually directly put transactions into your financial statement that are going to affect it. Great example of where things like journal entries become so powerful is things like stock management and work in progress. All of these sort of transactions you don't need to look at on a day-to-day basis, but to get your accounts right and your financial statements correct and more importantly compliant, then this is how you need to do it. Use journal entries to get that all done and dusted. And in short, a journal entry is a record of a transaction that shows the date, account, amount and description of the transaction. And that journal entry should go into a ledger. And a ledger is effectively going to be a collection of accounts that shows the balances and changes in each account. Common transactions that you'll see in your bookkeeping is going to be sales, purchases, payments, receipts, and all them are going to effectively be journal entries, just made super simple for you. It's going to affect those ledgers. Now, why we talk about journal entries? Well, it's all about the effect of adjusting entries and closing entries. The simplest way of looking at it is at the end of a year. At the end of an accounting period, you're going to need to make sure that your system is going to do these. Now, again, majority of the time, your system will automatically do this. As soon as you go from one year end to the next, especially if you use something like QuickBooks, it will automatically do your year-end journals for you, which is great. Problem with automation is sometimes that means we need to understand what the automation is to understand if it's done it correctly. And in some circumstances, you're going to need to make adjustments to those adjusting entries. And that's where things like opening balance journals come in. Basically means you're restating what the closing statements have already been done by the system, and you're bringing them in line to actually what occurred. Very, very common is the fact that your closing balances that happen in your bookkeeping solution won't agree with your year-end accounts, because the whole point of year-end accounts is we're going to make adjustments that bring them in line with what our compliance means. So we use year-end adjustments, opening balances, that makes adjustments to your accounts to ensure that we reflect correctly the balances and maintain them correctly. Now that we're getting to a point where we're actually starting to put all those entries into place, it's why bother? And the reason for that is at the end of all this, you're going to create what's called a trial balance, which is basically going to be all of your transactions in one nice and easy to see table. Now, the trial balance itself is effectively going to be all those debits, all those credits, all put together. So your trial balance should, as it says, balance. And it should be a list of all the accounts and their balances after making all your journal entries and adjusting entries and closing entries. A trial balance helps you check if your accounts are in balance and if you are any errors or discrepancies in your record. And what you really should be able to have a skill at is be able to use a trial balance to create and prepare your financial statements, because ultimately the trial balance is the fundamentals of what all accounts look like. You should be able to take all of the trial balance entries that relate to your balance sheet and create a balance sheet from them, and all of the trial balance entries that create a profit and loss account, you should be able to take a profit and loss from there. This is really advanced level stuff, but if you can do this, if you can get to this point, then I promise you from here on in, accounting and making sure your financial statement is an absolute breeze. The next stage, once we've got all your financial statements correct, is by using those statements and analysing them correctly. And what we like to use is ratios and indications to make sure that we can explain how your financial statements are as they are. Understand ratios of what your gross profit margin is going to be against your sales. Items like that will help you understand more about what's going on with those numbers, and take them from just numbers to actually a story about how your business is going. We would highly recommend you looking at comparing some of those yourself. Compare from one year to the next how much it's increased. Look and see how one number in your expense is related to your income and what the percentage of that's going to be. Maybe then compare it to the next year. That's going to give you an indication of how inflation may have hit it, how you may have lost control of that expense. You're going to come up with a lot of differences between the two periods, and that's normal. But the clever things to do is be able to figure out why. What's the story? What's happened? Why have all these changes happened? And that's when you're really going to start to understand what the financial statements mean to your business. And once you've done that, you're going to be able to see various aspects of business performance, profitability, liquidity, efficiency, solvency. You're going to be able to see all of these different factors that are going to affect your business performance. And it'll help you make better decisions. You'll be able to understand how market conditions, our customer satisfaction, as innovation are all going to affect how your business is going to be. And if you use some of the examples like ratios and indicators, look like gross profit margin and current ratio, then you're going to understand exactly how your business has gone, especially if you've got 1 year and another year to go against it. The final bit is making sure that you understand that further learning. For you, it's all about going to look at places like this exact channel. Make sure you subscribe to here. We're going to be giving you tips and tricks throughout your journey as a business owner. And it's going to give you opportunity to understand what other learnings we can bring. We would highly recommend our podcast, Ask the Accountant. Would highly recommend you looking at books and websites and courses that can help you understand more about the world of accountancy. Because understanding accounting means that you're going to understand your statements and understand what they're telling you, what story they're trying to tell. Every financial statement in the world is telling a story, and an accountancy and understanding accounts will help you understand what that story is. And normally, if you can understand that story, you're going to be better off. And also, because this is so complicated, this is where software becomes so important. Software is going to make or break the way that you can create these financial statements in real-time information. So getting something like QuickBooks is going to be fundamental for you to be able to understand how this is going, taking all the complication out of it, but leaving you with the opportunity to understand the value of what this software is bringing you. So this is your opportunity. Make sure you like and subscribe to this particular channel. Make sure you understand exactly what importance we can bring to you, because you can then figure out what is going on for your business. This is your opportunity. This is where you can understand what those financial statements mean and how they can start improving your business. My name's been Aaron Patrick. If this video has been any use to you, please don't forget to use that like, subscribe as we mentioned, and I will see you in the next video. Bye for now.